SARS does not only look at whether you submitted something, SARS also looks at whether your submissions make sense. And that is where many business owners get caught. They think, my returns were submitted, so I am compliant. But the real question is whether your numbers tell one consistent story. Quick transparency note before we continue. I am Sia's digital twin, created to explain business and tax topics in a simple way. The real Sia prepared the technical direction for this script, while he is busy helping clients inside his accounting practice. Now let's talk about 5 SARS mistakes that can make your business look suspicious, even when you are not trying to do anything wrong. Mistake number 1. Submitting late or only submitting when SARS follows up. This is one of the easiest ways to train SARS to watch your profile more closely. If your business only submits after final demands, reminders, penalties, or SARS follow-ups, it creates a pattern. Think about it from their side. A business that submits on time looks organized. A business that only moves when SARS applies pressure looks risky. Here is the problem. Even if the numbers are eventually correct, late behavior can still damage trust. The solution is simple. Build a tax calendar and treat SARS deadlines like supplier payment deadlines. Income tax, VAT, PAYE, UIF, SDL, and provisional tax should not be handled from memory. Mistake number 2. Declaring low income while the bank account shows bigger deposits. This is where things become serious. Your tax return says one thing, but your bank account says something else. Maybe the business declares low sales, but the bank account shows large deposits every month. The owner may say, some of that was loans or transfers. That may be true, but can the records prove it? SARS does not have to accept a vague explanation just because you say it with confidence. If deposits are not properly explained, they can start looking like undeclared income. This is where many small businesses get exposed. They do not separate customer payments, owner contributions, loans, refunds, transfers, and actual sales. Everything lands in the bank account, and only later does someone try to explain it. The clean approach is this. Every major deposit should have a clear description and supporting document. If it is sales, record it as sales. If it is a loan, keep the loan agreement or supporting proof. If it is an owner contribution, record it properly in the loan account. Do not let your bank statement become a mystery novel. Mistake number 3. VAT returns that do not match the business activity. A VAT return is not just a form. It tells a story about sales, purchases, input VAT, and output VAT. And if that story does not match your invoices, bank deposits, or sales patterns, it can raise questions. For example, imagine a VAT vendor submitting low output VAT, but the bank account shows regular customer deposits. Or the business keeps claiming input VAT, but the supplier invoices are weak, missing, or not valid. That kind of mismatch creates tension because SARS may ask, how can the business be receiving this level of money but declaring a low level of VAT? The solution is not complicated, but it requires discipline. Your VAT return must be supported by proper invoices, bank records, sales reports, and bookkeeping. Do not submit VAT from rough estimates. Do not claim input VAT because there must have been expenses somewhere. That must be document-driven. Before we go further, here is something you can do right now. If you are not sure whether your income tax, VAT, pay, payroll, and bookkeeping agree, book a free consultation with us. We can help you identify the red flags before they become SARS problems. Mistake number 4. Payroll returns that do not match actual salaries paid. This one is very common. The EMP 201 says one thing, the payslips say something else, the bank payments show something else again, and directors may be taking money from the business without a clear salary, dividend, reimbursement, loan repayment, or drawings treatment. SARS expects employers to declare PAYE, UIF, and SDL where applicable. So if the business has employees, payroll cannot be treated casually. Here is the danger. If your EMP 201 declarations do not agree with actual salary payments, payroll reports, pay slips, and bank records, the business looks disorganized. And when employee tax certificates are issued later, the mismatch can create even more problems. The clean approach is to process payroll monthly and reconcile it. Gross salaries, deductions, net salaries, and bank payments should all connect. If a director is paid, decide what that payment is before the money leaves the company. Do not call it salary in one place, drawings in another place, and owner's money in the bank description. Mistake number 5. Constantly changing numbers after submission. Corrections are sometimes necessary. Businesses make mistakes. Records arrive late. That is normal. But constantly changing submitted figures without proper documents can create suspicion. It can look like the business is not reporting from reliable records. Here is the problem. Amendments are not automatically wrong, but unsupported amendments are dangerous. The solution is to keep a clear audit trail. If a number changes, you should be able to explain why it changed, what document supports the change, and who approved the correction. A strong business does not only submit returns, it keeps records that explain the returns. So here is the big lesson. SARS risk usually starts when your numbers do not tell one consistent story. Income tax says one thing, VAT says another, payroll says another, the bank account says something else, and bookkeeping is trying to hold the story together with weak documents. That is when your business starts looking suspicious. Not because you are necessarily dishonest. Sometimes the real issue is poor record keeping, late bookkeeping, or rushed submissions. But from the outside, SARS may not know that. SARS only sees the inconsistency. So before SARS checks your business for you, check it yourself. Do your tax, bookkeeping, and bank records agree? Are your deposits explained? Are your VAT claims supported? Does payroll match salary payments? If you are not sure, schedule a free consultation. We will help you look at the risk areas. Because in business tax, one clean story is safer than 5 disconnected explanations. We'll help you look at the risk areas and understand what needs to be cleaned up.